Hello everybody, it's Ben Kumar and Tom Sheridan from 7IM. We're here to talk about the Q3 2018 Global Market Update. Now Ben, a lot of our competitors and a lot of our market colleagues have been commenting that the bull market in equities is getting on for 10 years now, and that in and of itself is a reason to take money out of the equity markets. Not so sure that that's really the right way to go about it. Rather, we should probably look at what's the cause of the markets going up for about 10 years, and is that cause actually changing? And the cause has got to be this little thing called QE, actually not so little. So we've seen that going on in various markets around the world. Is it in reverse?
Yeah, a lot of money was pumped into the system, and in certain places it is being withdrawn. The fear that people have is that interest rates are going to go up too far, too fast, and knock a global recovery into a global recession.
And what would high rates do for equities?
Investors look at higher rates and think, is growth going to be slower in the future? Is the economy going to be knocked off track? And if so, will companies be worth less than I paid for them? That's what leads investors to pull out of the equity market as rates rise.
Okay, so if the reversal of QE and higher rates is what we're looking at, are we actually seeing the reversal of QE around the world? I think it's not such an even picture when you look at region to region. What's going on in the US?
So in the US, we're well on the path, right? Rate hikes have come through already. We've seen 2 already this year. We're going to see probably 2 more, maybe 3 in 2019. The US is well on the path to quantitative tightening.
Okay, so the US is reversing QE. Europe?
Europe is thinking about stopping QE, not reversing, but just saying it can see the end in sight when it's no longer printing money.
Okay, so Europe is slowing. Japan?
Japan is not slowing. Japan's going to do as much quantitative easing as it can get away with. The main problem for Japan is that it's running out of things to buy with all the money it prints.
So Japan is still at it. China?
Well, China never really embarked on a massive program of QE. It had a big surplus going through the crisis and much higher rates, so it was able to spend money and cut rates without going into emergency monetary policy mode.
Okay, and last but not least, the good old UK. What's going on here?
Well, I think the UK would like to be in the US's position of raising interest rates, but we have the spectre of Brexit looming over us. So the Bank of England is not quite yet ready to embark on a full path of rate rises.
Okay, so the US is reversing it, Europe is slowing it, Japan is still at it, China never did it, and the UK is kind of, well, what's going on with Brexit takes precedence over what's going on with QE. Higher rates, what would generate the need for central banks to deliver higher rates?
The key word is inflation, and in fact it's inflation surprises. Inflation coming through quicker than expected means central banks have to adjust. They all have a target to keep inflation in check. If it looks like it's running out of control, they have to act, and that means raising rates.
So you've already said that the US is raising rates this year, telegraphed that they're going to raise rates again next year. What's going on with the rest of the world?
So in the US, you've got inflation coming through. It's a little bit above target, and the bank's raising rates appropriately. In the rest of the world, there's not much inflation going on. In Europe and Japan, inflation is below target and looks like it's getting a little bit weaker. So there, interest rates don't look like they're going up anytime soon.
So if we have a situation where the US is raising rates and the rest of the world is not raising rates, this interest rate differential starts to widen, and the probable implications for that, and indeed we've already seen it, is a stronger dollar. What implications might a stronger dollar have, and is this a reason for people to worry?
Markets have been getting worried about a stronger dollar. You can see it in the chart on the screen. The dollar has got stronger over the past few months. There are a number of reasons that it worries. The first is that there are some countries out there, like Japan, like some of the emerging markets, who've done a lot of borrowing in dollars. Now, as rates go up and the dollar gets stronger, it gets more expensive for them to repay that debt, to repay the interest and to repay the capital. That can create frictions in the financial system that cause a little bit of stress.
So if a strong dollar is not so great for some people, some countries in the world, what does a strong dollar do for the US?
Well, you'd think it'd be good. It sounds good. Strength is good. But it could mean that the trade deficit widens, that exports fall, and that Donald Trump probably gets a little bit agitated.
Well, Trade is the magic word these days when you look at the political arena. Not that we want to focus too much on that, but what are the prospects for an irrational trade war?
We're not sure about Donald Trump's rhetoric, we're not sure about his negotiating style, but what we can see is that this year it's been taken a bit more seriously. Look at the chart on screen, that's the Chinese stock index. It's fallen more than 20% from its peak. Technically, China is in a bear market. It started falling about the time Donald Trump started really talking about trade wars. So there is clearly an impact.
All right, so if people are looking at this 10-year bull market and the possible uneven reversal of QE, high rates, inflation, trade wars, what's the other side of the coin? What do economies look like, and more importantly, what do earnings look like in the companies that we would invest in?
The answer is that economies look good. They look really good. In the major developed economies and most of the developing ones, we don't see any prospect of a recession in the next 2 years. That is good in and of itself. Add on to that the fact that companies are increasing their earnings. They're taking that growth in the economies and translating it into profits. And the final bit is that they're translating it into profits at a higher rate than expected.
That, for me, is the critical piece. Not only that economies are looking good because they've been looking good for pretty much most of the duration of the bull market, but that earnings are good and earnings are exceeding the expectation. And it is in that scenario that we believe equity markets can continue to make progress. Therefore, what we're going to do is we're going to keep our normal equity weightings going forward. And that's the key message that we have from 7IM for Q3 of 2018. Ben, thank you very much. Thank to all of you for your support, and we'll see you next quarter.